You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is financial consultant Richard Knowles of Knowles & Associates in Vancouver. Welcome to the show, Richard.
Thank you very much.
Today, we're going to be talking about the importance of diversifying your portfolio and also about Prime Minister Stephen Harper's trip to China. Well, first of all, let's talk about diversity. We've seen gold shares take a pounding. We've seen oil take a pounding. So, Richard, perhaps again, get across the message that don't put all your eggs in one basket.
Well, Jim, I think that the real message here is to not have let emotions erode the basis and foundation of investing. If you go back, over 100 years, 200 years ago, we started with very basic concepts of high wealth management. These wealth management concepts have probably been around a lot longer than that, thousands of years, frankly. But our recorded modern-day economic history started in the Industrial Revolution at the turn of the 1800s. And these premises have been established as very basic, but they're not just investment premises. These are premises that you can use in anything in your life. So in effect, it's a philosophy that you have to adopt when you invest. And the key to this philosophy, and I'm speaking of Warren Buffett, I'm speaking of the top wealth managers on the planet, will tell you this, by the way. I'm quoting them. There's nothing I can tell you that's new, by the way. I wish I came up with all these things myself. I'm just not that old. But I can tell you, and I can at least paraphrase properly, the facts that have existed with the highest, wealthiest people on the planet, not just in this country. Now, one of them is the one that I live by when I manage money for my clients and even myself. And certainly I profess this to everybody. When you set a program of investing, you look at creating a blueprint. Now that blueprint has to fit you. Forget about somebody else. Now, if you want to change over time, you're allowed to do that. You have opinions, you have emotions. They are allowed to be addressed in every blueprint you create. When you create your blueprint, you've got to build in a broad base of understanding. In other words, if you're not risk-oriented, even though somebody else beside you loves riskiness and loves to take the chances and, gets better returns, you're happier not having that sweating every day and you can sleep better at night. You're just different from them. You can create a diversified program, but the key is this. Now that you're diversified, you've got your bonds, you've got your stocks, you've got your gold, you've got your oil, you've got a portfolio. Over time, that changes, but you want to rebalance that on a regular basis. Now, when you do that, you've set your blueprint. Whatever that may be, it's yours. The key now, and this is the big one, and this is what people fail in doing, is not allowing your emotions to change the blueprint, to erode the work you've done. You have to get back to principles. When you see markets going like crazy and everybody wants to tell you, your taxi driver tells you to invest in Nortel, which was happening during the Nortel phase, when Nortel was flying through the roof in Canada, everybody, including your waiter, everybody was saying, buy Nortel, I can tell you all about this is the best place to put your money. As soon as that starts happening, you want to sell Nortel. Or you want to sell. And that, if you had actually done that, you'd be a very profitable individual today. And if anything overtakes your portfolio too much, you size it back down. You stay within your blueprint. You stay within your principles, and you keep diversified properly over time. Your wealth will accumulate strategically and safely. That's the key to investing well. The second part is not to allow your personal emotions on a day-to-day basis, either somebody talking to you from the taxi or perhaps your own fears or your lack of knowledge, to erode the framework that you have built. Now, I've actually quoted Warren Buffett. Now, and he's of course created this along with many other great wealth managers in the world. No one of any significant wealth ever has invested in one thing only. They have always diversified. Now, they may have made their wealth in one thing initially by either sheer luck or timing or a business they own, such as an oil business, which is all in oil. But after they got their wealth, they did not stay in the oil business. They diversified and held other investments. All great wealth diversifies. Follow that premise and you'll be safe. One safe way to buy Warren Buffett's philosophy is just to buy Berkshire Hathaway. That's what a lot of people do. And it's done very well. It's a holding, but it's a holding of other things. It's like buying a giant mutual fund as an example. But I'm not recommending people do that. I'm saying that if that's what you believe and you investigate it yourself and get a good financial advisor to help you to get the information you need if you don't get it yourself. But at the end of the day, having that as your principled way of doing things gets away from the noise. There's so many people talking about, call and put straddles and all these little techniques to make $1,000 a day if you can on, $20,000 portfolio. But literally you could lose $5,000 in a single trade. These kinds of products and strategies do work, but you always find the most desperate money doing this. It's never the smart money. The established money, the large dollars, do not chase these high risk strategies. They don't have to. So the wealthier you are, the more you go towards the final strategy, the real strategy we should all adopt initially, which is to devise an organizational plan of a diversified portfolio, which there's lots of numbers in. I do this for people all the time, of course, because we have the stats, and I can structure a portfolio that can show low risk but higher returns, and et cetera, et cetera. I mean, I've got all the numbers. I've got all the different types of things you can do from a portfolio strategy. But once you've established this, is not to let it get eroded over time by what we call in the industry the noise. The people saying, well, I can do this better, I can do that better. Maybe you should take all your money and put it into 5 banks because that'll do everything for you, and you can cut your fees down. Well, at the end of the day, it's penny wise, pound foolish. That's what it ends up being. So it's a matter of being strategic and implementing almost like a mathematical formula. It works statistically. We know the math is there. The arithmetic works. It's almost a law. If you stick with this, it's almost a physics law, that if you stick with this way of approaching investing, you will build and accumulate, and more importantly, secure that growth. I can show you tons of days where I could be making more money in a single day than most people will make over 2 or 3 years. But try and keep that without letting other strategies, more aggressive strategies, lose it. And here's an example of that. Last year, you could have made 40% in a couple of mutual funds. And if you sold them at the right time in July, August, before the fall comes, you'd be sitting, assuming not too much in capital gains tax. If you could avoid the tax, let's put it that way, you'd be sitting with a 40% return for the year. Now, when do you reinvest? Have the markets dropped? I mean, we're still at all-time highs. I mean, should you still be in the markets? What's your decision now? Do you jump back in now? Do you wait? If you don't have the strategy of where to position, and if you don't know the numbers of price-to-earnings ratios and understand things that show good value to buy, you shouldn't be a buyer. You shouldn't even be a seller. You should allocate that job or duty to someone else. A good example of that would be holding mutual funds, where the allocation of the decisions are being done by extremely intelligent people that use diversification as their premise in each one of their investment groups or portfolios. And you can buy multiple portfolios or multiple mutual funds, however you want to look at that. And there's other ways to invest, too, to secure your principal so you never show a loss. The market index accounts and other types of things. Knowing the products, knowing what's available out there is more than half the battle. Most people think it's a simple formula. It's not as simple. It can be simple for some, but it's not as simple when you realize so many opportunities and you're not even aware of them. They exist, but you're not even aware of them. So getting information, getting it properly done, diversifying, creating that blueprint. Once it's done, you can sit back. You've done all the research. You've done all the work. Now you just have to monitor it and keep it alive. Keep it balanced, and don't let your emotions get involved. Stick with your original research, stick with your original knowledge, and just tweak it as you go. Once you build your car, once you've got your engine running, you don't have to go rebuild the engine every year. You don't have to go sell your engine out and put in a new engine. You don't have to do it. People do that. Race car drivers do it all the time. They pull their whole engine up, put a whole new engine. You don't need to. Do the pragmatic approach. Put in a good engine, build it right the first time, and you just have to tweak it. You have to keep it oiled. You have to keep the gas coming in. You have to properly service it. But if you do that, you can keep a car going far longer than the lifespan of a regular engine. That's the key. Don't let your emotions erode. Don't let somebody look at your engine going, I got a better engine than that. You should have my kind of engine. Don't let them sell you on that. Your engine works. If it isn't broken, don't fix it.
Canadian Prime Minister Stephen Harper will be visiting behind the bamboo curtain. We'll have more with Richard Knowles right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. I'm Jim Goddard. We're talking to Richard Knowles, financial consultant at Knowles and Associates in Vancouver. Prime Minister Stephen Harper and his wife were off to China for a 5-day visit. Of course, he'll be there for the opening of the APEC conference and talking about Canadian trade imbalance with China. They sell so much more to us than they buy from us. But Richard, you're saying there could be also kind of a secret agenda going on here.
Well, I think everybody knows that it's not that much of a secret. It's a photo opportunity for Stephen Harper to show his international acumen, I suppose he would like to put it, on the international stage for the up-and-coming, representation in the voting public. He wants to position himself as the leader for the next voting Conservative government. Hopefully he gets voted back in for his sake. Everyone has their own opinion on these things, and whether he's worthy of another term with all of the other specters that have been sitting over his current party. Although he hasn't personally been implicated in anything, he's sitting now on at least, I believe, 11 different members of parliament in his own party, including in his own office, that have been indicted in the federal courts. So this is not a very pretty re-election period. So he is trying his best to try and position himself to look good. So we believe, pretty much across the board, those in the know are saying that this is a major photo opportunity. The reason he's just done this, he's doing this now, is because he kind of ratified kind of a sneaky trade agreement, as has been put out on the net, if you like to look at it. Most people, Huffington Post, others that are trade advocates and consumer groups, including members of parliament of the opposition party, have stated that he snuck in a new China-Canada accord called the FIPA agreement, which unfortunately, according to many people and many pundits, feel that this is not working in Canada's favor. Now, of course, there's different opinions on that. There are some benefits to many FIPA agreements that the government puts into place. These are free trade type of agreements with other countries, and we have many. They're currently working on approximately 11. We have 17 already actually in place, including China's. These investor protection treaties are really what we call them. And so it's an investor protection agreement, hence the IPA. So what we have here, however, is there are important issues with this particular one. And the reason is that the liability in a FIPA agreement typically, and in almost all cases, relies on the country that receives investments. So the FIPA agreements we have secured, the other 17 I just spoke of, were with countries where Canadian companies would be investing. So, for example, I believe we have one with Peru, or Colombia, where if our oil or mineral companies were to go down from Canada, were to go and invest in projects in these other countries, if for some reason something were to happen in that country where the Canadian company would be held financially liable, where they entered in good faith, that is, the Canadian company enters in good faith with an agreement with the country to do some mining in that country, and for some reason the country changes the law or does some sort of change of heart and comes back to the Canadian company and says, listen, you can't do this now. So what that means is if we have a FIPA agreement with that country, we can actually sue them in a federal court type of situation, and that country would have to reimburse that Canadian company any investments they have made to that point. That's assuming they've entered in good faith, they've put in some money on the table, and the country has given them a green light, and suddenly something changes, and then they're out $200 million for the exploratory expenses. They want that money back. So this is what this investor protection agreements are all about. However, in this particular one, we happen to be the smaller country with China. This is our first major one with a big country like that would be investing in us rather than the other way around. So what are the key features that maybe Harper doesn't want us to know and certainly has not popularized and has tried to keep under wraps according to most of the pundits? One, Chinese investors will now have the right to challenge our laws in our own courts with no recourse, that is, to Canadian courts. So they can challenge our laws in private with no recourse for us to go to Canadian federal courts under federal Canadian law. Okay? So they can challenge our laws, and therefore we have no recourse to challenge that in a Canadian legal system. That's a very important issue. One, and that also works for us in other countries, mind you, but this is very big. That, you know, does Canada really want one of these if it's that much risky? That's the key that has never been debated, because he signed it, of course, in secret. Now, he's allowed to do that. I should point out, many people have said, oh, you know, he signed this in secret. There was no debate. Well, the reality is that under Canadian law today, the Prime Minister of Canada has a right to sign any free trade agreement of this nature, not free trade per se, but investor protection agreements of this nature, without public debate. That is the law, and so a Prime Minister can do that. Now, whether he chooses to do that from a political standpoint on such a sensitive issue may be unwise, and I think it has been in this case, but he has the legal right to do so. However, he did sneak it in. He signed it. He didn't announce it. There was no public announcement. And so you have to wonder why. When something is good, they always publicly announce it. They say, look what we've done for Canadians. But this one has never been popular with anyone, it seems, at this point, except, of course, the federal government and certain, you know, self-interest groups. So the second point, the government can keep lawsuits secret. So if there's a lawsuit that's brought up, it's behind closed doors. It's settled by government to government, and it's not exposed. Now, this is important because if anything legally is settled by China in Canada against a Canadian company, it'll be the Canadian taxpayer that will be paying China. It's our tax dollars. And yet we won't even know that the money is being siphoned to that because it's being kept from us in public. There's no public scrutiny. The third one, there's been no public consultation or debate or legislation. Again, not illegal for him to do, but it has been politically a poor point for him to do such a thing. The next one would be Canada will be bound by the treaty for 31 years. Legal treaty for 31 years. This isn't something we can get out of at all easily. So, for example, NAFTA, which we know all about, the free trade agreement with the United States, it can be terminated in 6 months. It was built into our contract. We're allowed to terminate it. I think it's either way for Canada or the U.S. to terminate that agreement in 6 months. There's no legal holding. But the Canada-China FIPA Accord runs a minimum of 15 years and has a 1-year notice of termination period and extends rights to Chinese companies already operating in Canada by 15 years after the deal is canceled. So we have a minimum of 15 years we're hooked onto this. We can give a 1-year notice of termination, but any Chinese companies that have been with us under this agreement have an additional 15 years guaranteed under they're grandfathered under the deal, even if the deal has been canceled. This is a very, very difficult thing for many Canadians to fathom. So, you know, some say it's a better deal for China than for Canada, and I think that FIPAs have been advantageous to Canadian businesses, let's be honest, in general, because they've largely protected Canadian investments in other countries, as I mentioned earlier, you know, Canadian mining companies, etc. And that's actually, I'm giving you the verbatim from the Council of Canadians, which is a well-known council of consumer protection in Canada. But with China, Canada's now on the other side of this equation. So it's now we're considered the destination country for the investment. So, in fact, according to Gus Van Harten, who is an Osgoode law professor, Canada will be and I'm quoting him, by the way, Canada will be much more exposed to claims and corresponding constraints than China under this deal. So we are at a disadvantage under this deal, and therefore it's not politically motivated to help, you know, Harper to publicize this. But now, in a sense, he's going across. We feel he's going to do a bit of a show on an international basis. He wants to show himself to be, I suppose, the famous Nixon of his day, you know, the international guy that went into China. And we now, you know, I believe perhaps the conservative government sees him as reopening that sort of vision, which is a positive thing about Richard Nixon, by the way, which is that he did well in China and he spoke well to the Chinese government at that time and was able to come to many agreements. But you know, it raises a specter of I don't know. I just think it's poorly timed. I think the signature, according to some, he signed it just in September for this photo opportunity in November. So it seems to be a bit of a specter is overhanging this otherwise, cordial visit to a Chinese government. And I think that's the big criticism today. And all, of course, the specter of the legal challenge by the First Nations of this particular agreement was overhanging the signature in September, which makes you wonder how he could have signed it with the First Nations launching a court challenge on the constitutionality of the deal. Now, it was thrown out in the BC Supreme Court, rejected the argument just October last year. So under that specter, perhaps he felt that this has been challenged and therefore it's overturned, so he could go ahead and sign it. Harper could sign this agreement. However, the First Nations have now been appealing that ruling since then before the Federal Court of Appeal, which has not yet settled. So he signed it under very inauspicious situations, which he should have, in theory, waited until things settled before he made that decision. Now, what if the Federal Court of Appeal agrees with the First Nations? Now, one has to wonder whether there's a case there, and if there is, how will Harper's government deal with this? Again, every dollar that's spent in this kind of situation, we can't overturn it now that it's signed. They're grandfathered. We have no out. We can't do anything for 15 years. This lack of, stewardship is really the key feature to this example of an agreement that locks Canadians. He could pass away on this flight, and he's locked all the rest of us into this agreement. And we cannot go back and just suddenly cut it off unless we negotiate out. And if that's the case, one has to wonder whether China will just let us go out of this for some reason. They have every reason not to. They have the ability now to come into Canada, invest in our oil companies. They feel safer doing that. They can't just be thrown out. They can't just be cut off. But under this agreement, it's possible that they could get out of many different types of current Canadian laws under Chinese employment, etc., standards, etc. We don't know. So it's a very big risk issue, and it's a big specter over his visit.
Richard, thanks a lot for chatting with us.
Thank you for your time, and I appreciate it.
My guest has been financial consultant Richard Knowles of Knowles & Associates. If you have any questions for him, you can send them to Richard K, that's the letter K, at customplanfinancial.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. We're also available on YouTube. Our channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.